Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to give you the quick, fresh update of the market. Today, Tuesday, 12th of March, and let's take a quick look of how the week is evolving, how it's going, and also what was the first market news comment. We did the close of the week last Friday, and we also mentioned during the last Friday that it was very interesting. Observe how the last numbers published during the Friday evening, which it was the labor market in United States. It was actually increasing the unemployment rate by 3.8%, if I'm not wrong, from 3.7 expectations on the market. The reaction of the market was initially was positive because obviously what the market is waiting for right now, it's a reason to increase interest, to cut interest rates, and the reason to cut interest rates could be a clear signals of labor market getting weaker, an increased unemployment rate which will contain inflation, and therefore if the inflation is not anymore a problem, Federal Reserve will cut interest rates with no doubt. The problem is that regardless that increase on unemployment rate is still super low, it's 3.9%, and I also shared with you on Friday an interesting chart proving our point, which is that even regardless if the labor market is getting weaker or unemployment rate is rising, even in that cases, still we are facing one of the lowest levels in history. This is not the right one. This is actually a very interesting one on 10 years and 5 years bond in United States. But the chart I would like to share with you is this one I published on Friday, just to give you a clearer picture of what really is going on. As you can see, in 2000, in 2007, 2020, and 2024, we have seen a labor market that was touching almost 4%, lower than 4%. In both cases, it was always the intro to a new recession. Super low levels on unemployment rate level. It was actually the intro for a new recession. It was in 2000, before 2001, the crash of the dot-coms companies. It was also in 2007, just before the crash of the subprime mortgage, and in 2020, obviously the pandemic year. Now we're in 2024 and we are facing exactly the same situation. Now the thing is this actually the first moment or the first previous moments before the storm actually happens, before we actually see that the recession is coming? It's a good question. So far what we can see is the market is still rising, and this is the thing. Today, Tuesday, 12th of March, we got also data, which it was the inflation rate in the United States, and it was 3.8% versus the 3.7% expected. And it's also interesting to observe that actually inflation is not dropping, is not under control, and I think that's the main concerns that Federal Reserve got. And please don't forget that we have started the year, this 2024, with one expectation, one single expectation. It was the interest rate cuts. But since the last year, since actually summer last year, July, we have seen how the market has been stuck there. As you can see, all these months has been almost flat, around 3%, coming from 3.1 to 3.7, dropping back again, rising back again, dropping back again. And now the last numbers we got today, it was actually inflation rate is rising back again, which is 3.8% versus 3.7% annualized. Is the worst scenario, because in that case, again, Federal Reserve is not going to cut interest rate. Why this is important, why I'm making this emphasis on the fact of the interest rates and labor market? Well, mainly because all the movement you have seen in equity in United States and even in Europe since then has been caused by the expectations of an interest rate cut. This is October 2023. January, all this movement up, breaking out the maximums, the new records, has been under the idea or assumption that the Federal Reserve will cut interest rate. It didn't happen, and remember, by December last year, few months ago, the expectation was interest rate cuts by March 2024. Okay, well, we are in March 2024 and still we didn't cut interest rates, and still Federal Reserve is talking about when exactly they will do it. The market is discounting now that probably the interest rate cuts will come by June, and still they're moving forward. Initially it was March, then they will start to talk from March to maybe May, and now that after May, the expectations are June or July. And even some top economists, it's not just this report I'm doing for you and published on ATFX Connect blog, which I have been mentioned for the last 2-3 months. Watch out, be careful. This bullish market is just fit by a lie, which is the interest rate cuts will come immediately, and it's not true. And there is no macroeconomical reasons to cut interest rate in the United States, because mainly it's Europe, the one that is in recession. Mainly it's United Kingdom. By the way, we also got macroeconomic data coming from United Kingdom, and take a look. It is not growing. United Kingdom also got certain issues with the growth rate, and therefore this is the countries that need cut interest rate, and not United States, with the growth rate in the United States is still super strong compared with the rest of the countries. United Kingdom, United States, and even take a look on Europe. You will see. This is Europe. So obviously, if someone needs interest rate cuts, if someone needs a stimulus, it's Europe, United Kingdom, Germany mainly, but not United States. And this point that had been my main point in all our reports for the last few months is now the point that some economists are pointing in the same direction right now. We got around, let me just read you one of the main economists, which is on the report of today, include his words, and you will read only in not just by my view, by my position, but also in economists like him, the reference of what they believe, which is even that maybe the interest rate cuts will not happen this year. And I know it sounds crazy, but it's also the chance that maybe will never happen this year, the interest rate cuts, because some other analysts are pointing in this same direction. There is no reason to believe that interest rate cuts could happen, and that's why Federal Reserve is postponing the interest rate cuts 1 month after another. And you got all the numbers here, all the reference, if you want to see this in detail, to understand the position of the Federal Reserve right now. The PCE inflation, what was the previous and the current one, what's the expectation for the next year. You also got the comments by the Reuters polls in relation of what's the expectation of interest rates. The first cut will occur in March, and traders will then shift their bets to May, and actually it's expected to the future coming interest rate cut will happen in June by now. That's the last expectation that we are talking about recently. But like I say, there is a chance that there is an option that maybe interest rate cuts will not happen this year, because still the numbers are not justifying that interest rate cuts compared with other markets. Let's take a look also to the SP 500. Don't forget that this Friday we got actually the triple witch hour, which is the when all derivative contracts on options and future will expire, and we will see how the new contracts run over, if they come in backwardation or if they come in contango, above or below the current price. It will be probably one of the signals that the market is waiting to see to understand if the market is bullish or is bearish. So therefore, high volatility will come this Friday with expiration of these contracts. So keep attention, keep an eye on this market and pay attention to what happens on Friday. As you can see, SP 500 right now is just coming back after the drops that suffered during the Friday, after the numbers from the unemployment rate rising. And still, this is nothing. The correction is probably something more serious than this. We have seen just the market dropping, but coming back again. Even in Europe, as you can see here, the levels are quite high, quite strong. This is the DAX 40 German market. And again, there is no reasons to give or support, fundamentally speaking, from macroeconomic perspective, that this market could keep rising over and over again. As you can see, this is a super long-term chart. It's coming from 2015, but even if we look for longer data, you will see that since 2009, which means like almost 14 years since then, we have seen the market just rising. But in this channel, that obviously is giving us a signal of probably we are touching the top of the roof of this channel, and therefore sooner or later we will see a market correcting waves on the market for maybe a couple of months, 2-3 months. So that's the movement we're expecting. That's the movement that we are looking for, because it's too late to start to be long in a market that is clearly dilating the price over the expectations, and therefore we should be really cautious in this sense. We also got the commodity market going crazy. Gold is rising to the levels of 2,160. We talked last week on our weekly report, and again, you can find the weekly report in our ATFX Connect website on the section of blog, market and snacks. Last week, we were mentioned how the ETFs on gold are reducing liquidity, and therefore, because there is a lack on liquidity, maybe it's also why one of the reasons the market is keep rising. We also analyzed geopolitical factors here. Some of the factors was, for example, that after what happens with Russian assets in London and in Euroclear in Europe, frozen 300,000 of million of dollars in Russian assets, probably rest of the countries from that BRICS bloc, which means like Asia mainly, and many other countries, they probably are moving their assets from West countries to gold reserves. And that's one of the main reasons why maybe central bankers in Asia, particularly, they are increasing their purchase on gold and holding more and more gold just to bake their assets instead of dollar. Saying that, it's interesting also analyze what is going on with the dollar index, which is here, which is rising back again. It was falling on Friday after the unemployment rate was published, because obviously if the unemployment rate was rising, Federal Reserve could cut interest rates. And if the Federal Reserve cut interest rates, obviously the movement of the dollar index is down, is low. It didn't happen. I mean, it happened until this level. And for some reason, it's finding support. I believe it's because there is certain shoulders here that maybe by symmetry is causing this movement here. But still, it's too early to predict this movement or to say this in detail. Also, another indicator that is working really well to predict this interest rate cut is the 2 years yield on US Treasury bonds. So you go to US Treasury bond 2 year, you will see that actually, if the bond is not dropping by below 450, we cannot actually say clearly that interest rate cuts will happen, because obviously this is discounting the relation between interest rates and yield is positive, is proportional. So if the interest rate get cut, this yield gonna drop because the demand of bonds gonna increase. But if the interest rate, if the yield of this bond is rising, is still rising, and as you can see, is now almost in 4.60%, it means that the interest rate cuts are getting away. So in other words, if we see that the bond is moving upwards, it's keeping away the possibility of the imminent chance of interest rate cuts. If it's dropping below 450, it means the interest rate cuts are coming and it's happening. So it's one of the most interesting indicators you can follow for this. In oil market, we can see that the price has been rising, but it still is so lateral. As you can see, it's not moving really for the last couple of weeks. Has been just there frozen completely from 83 something to 80, $81 per barrel in Brent. So nothing really is going on. We got certain meetings of OPEP coming this month also, but it doesn't seem that it's causing any kind of difference on the market, which worry also, because could be one of the reasons could be the global demand is dropping. The last one is actually Bitcoin. Has been rising a lot. It did actually broke the new top records about $70,000 per Bitcoin. Right now it's just turning back to 69,500 almost, which is completely fine, because it's gonna happen. Sooner or later that correction will happen, and still the levels that the Bitcoin has conquered for the last few weeks is actually the next support that it's gonna use the market. And that's why I believe we are watching one of the best assets for this year. It was also one of the best assets for the last year. Even when the market was dropping, Bitcoin was rising. Even when the market was rising, Bitcoin was rising. So regardless what the financial assets were doing, Bitcoin seems to be rising. But this last movement, it was too much. This is too much. This was natural movements. You can see how the Bitcoin is going up, correction, but overall, at the end of the day, is increasing his value. But this is probably a massive dilatation on the prices, and therefore a correction is it's a natural event that will happen sooner or later on this asset. I think that's all. Remember, we are updating this report every single day, so you can find this in every morning. I also do it on a newsletter format, so if you want to receive on your email completely free this report, you can just simply send me an email, contact me through the email, request me to have you in my newsletter, and I will just put your email on the queue, and you will receive these reports, but you will see the reports on your email. So you're gonna get all the information of the last 24 hours regarding markets, asset, commodity, equity, fixed income, last comments from central bankers, and obviously an interpretation of what was the macroeconomical perspectives, and geopolitical comments about what is going on in the world. All right. I hope you enjoyed this video, and if you did, please give me a thumb up and subscribe to our channel, so I will know that you are there and you appreciate this content. Thank you, and bye bye. Take care.